Hi and welcome back to part 3. This is where I give my macro outlook. Okay, so where do we start? So I think we'll get a bit more insight this week of what to expect for 2024 because we've got some major central bank rate decisions coming out. ECB, the Fed, Bank of England, and more. And of course, that is not just a decision, but then it's, the press statements and questions afterwards from the press themselves, which is really going to start to sort of highlight what is going on, what their expectations are for next year. And, if you're active still for December and you're watching this data coming out, remember for the FOMC that they will release the dot plot this time round as well, which is really good because that will impact the markets and give you a bit more insight into what they expect rates to be for 2024 onwards. For me, as I say, I still think that, I say this every week, that they're going to keep rates unchanged at the moment, but not so much just that, but they're still going to warn that they're going to stay higher and for longer, and probably longer than most people expect. They're going to be data driven. But they're not going to, in my mind, they're not going to be in any rush to start to cut until that inflation levels out at that 2%. And as I keep saying, they're going to want to see that for months to prove that it's going to stay there, and not, if they cut too early, it could just start to push it back up again, increase in demand. So obviously they're going to be very slow to cut rates. They're going to be very calculated in those rate cuts as well. So US data last week was a little bit mixed, especially on sort of the employment. Friday's NFP probably caught most people out. It didn't catch me out. And the reason for that was I warned on LinkedIn that could be a little bit distorted. Because you had a lot of strikers going back to work, and of course seasonality, Thanksgiving, more employers, part-time even, and then of course moving on to Christmas period. So, it didn't really surprise me. And of course, even so, the US, so, the dollar strengthened last week, right up until Friday's close. Is making that little bit of a consolidation now. And for me, what sets the US apart from its peers this year for the economy has really been the impact from all of those trillions of dollars of stimulus that they added during COVID. And obviously that's helped to keep the stocks higher and also demand higher. Household wealth is still well above where it was pre-COVID. But of course, once those rates start to fall, as inflation even nears that 2% or it hits that 2%, it's got to stay there to convince the central banks to start to cut, though, I believe. I think the ECB could be the first. Bank of England's borderline on when they would start to cut, because obviously we've still got higher inflation. They've got to balance that with the economy and what else is going on. But in the US, I really don't think that they will cut rates until the second half of the year. But, again, just remember, this is my personal views. So once we get that sort of inflation back under control, once they start to slowly cut rates, it's going to move the attention elsewhere. And where is that going to move? And to me, it has to move towards the debt levels, and that's personal debt, corporate debt, government debt, and towards jobs data. There's still other risks out there, of course, and the biggest one that remains is the geopolitical risk. We've got 2 wars going on at the moment, and of course, there's so much in the way of international effort going on to prevent them from actually spreading. And of course, that maybe there's going to be more in 2024. I don't know, obviously, but it's something to bear in mind. But the impact on the markets hasn't been as damaging or as crazy as it could have been. So coming back to sort of the companies, and their profit margins have been so high that, and obviously it's helped some of, especially the Titans, to have performed well. You've got tech, but not only that, I mean, airlines, I mean, what a turnaround during COVID. I mean, they was rock bottom. Nobody could fly or anything. And then, of course, now no one can get enough of flying, and they're struggling with demand. Well, to keep up with the demand. And then, of course, the same for entertainment as well. That's just naming a few of them, but, a drastic turnaround there. Now, energy's been a bit of a strange one, because obviously OPEC's been cutting, 3-4 times this year to try and boost oil prices, but it hasn't really worked for them. Energy prices are struggling. They tend to try and have a little bit of a rally, but they just fail. And of course, some of those inflate. What it is doing though is it's helping release or remove some of those inflation pressures. And as long as oil doesn't start to have a bump, then that potentially is going to help to bring those inflation levels down. Oil is one of those contracts that's impacted by the economy, but definitely impacts the economy as well. So, I mean, commodities in general are lower, and as I said, that is really surprising, considering we've got these ongoing conflicts. Surprisingly, I suppose the one exception to all of that has been the soft markets. Cocoa, coffee, and such like. They've been pretty bullish this year. So, so after next week's central banks, you've got to be a little bit careful going into this last week or two around Christmas. We say it's for the needy and greedy, but volumes drop, volatility increases. So if you're going to trade, make sure that you cut your size down and widen your stop losses. That allows you to stay in the market for longer, but without increasing the potential loss, and that's important. What you don't want to do is destroy your account just before Christmas. So be cautious, be careful, and always just go for those high probability trades. Now, there's other things to consider as well. What asset classes are you trading? Have you got experience with all of them? If not, then reach out to us, because we can help you to get that understanding. Do you understand the fundamentals of the markets, or are you purely technical? Again, having both is such a bonus, and understanding all the different asset classes. There's been some great opportunities this year, and fortunately, obviously, I've got 50 years in the market, so I can sort of turn on a penny to different asset classes. But of course, you can benefit from my experience. Just come and do one of our courses, and I will pass on as much of that knowledge and my trading skills as possible within the time you spend with me. So, sort of just reach out. Even if you just got questions, I'm always happy to hear from you guys, and help wherever I can. So, okay, so now we are getting ready to move on to the part 4, where I do some technical analysis for you. And again, I do courses on this because I've got my own way, my own charts that I use. I stick to the basics here for you guys, but there are other charts that I use in 1 or 2 studies, so happy to go through them with you as well. Okay, that's it for now on this part. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. You know, apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So, you know, that's you know, I'm not saying I'm going to turn you into a massive trader in 20 sessions, but, you know, getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. You know, maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4. As usual, we start with our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, although hopefully it is for you. When it comes to leverage, just be careful because you can lose substantially more than that initial investment. Everything we include in here is just purely for educational purposes. You know, we're not trying to provide you with advice, we're just trying to help you prepare, understand the markets better, to help you make better decisions. But of course, you know, if you are looking to invest or trade, that has to be your decision. And before you make that, you should consider your financial situation, your level of experience and your risk appetite. And of course, on your risk capital, you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before risking your capital.